In this week's video, we'll review a wide range of data sets to help us answer the question, are the charts starting to cast doubt on the strong economic thesis? We've got a lot to cover, so feel free to use the pause button on your video player. These are the topics that we'll be covering. Calls for a recession in the United States have been frequent and ongoing over the last 24 months. The charts we covered last week and the data that we had in front of us last week had not yet lined up with the imminent recession thesis. If we fast forward a week, the tweet on the left side of your screen from Friday morning, February 2nd, still applies. And the fact that the economic data over the past, let's say 12 to 18 months, has tended to come in stronger than expected rather than on the weaker than expected side, all of that aligns nicely with an economy that's being driven by favorable demographics. If we examine the S&P 500 on numerous time frames, and maybe more importantly, market participants' desire to own stocks relative to their desire to own more defensive-oriented bonds, a concept that was covered in this article here in June of 2023, everything discussed in that article has been helpful over the last 8 months, with the chart of the S&P 500 relative to the price of a 10-year Treasury note breaking out of a multi-month consolidation box last spring, consolidating above that breakout level, and then pushing to a new high after the market rallied off of the October low. The chart on your screen really doesn't look anything like this, or this. You can better understand this chart by pausing your video player, looking at these bullet points and these bullet points. Compare and contrast the look of the S&P 500's weekly cloud chart on February 1st, 2024 to the improving look that we noted back on June 2nd, 2023. Checking all of these boxes on the left side. S&P 500 with moving averages ranging from the 50-day out to the 200-day. It's relatively easy to see the trend roll over and then try to turn back up in Q1 2023. We had a scare in October of last year, but the entire time the 200-day moving average in orange held on to a confident and try to be patient look. Since then, the S&P 500 has gone on to exceed the high that was made in late 2021, early 2022. Monthly momentum in 2008 really doesn't look anything like monthly momentum in 2023-2024. This looks like a counter-trend move within the context of an existing uptrend, with the bearish cross and the bullish cross taking place above the zero line. We've got bull market looks rather than bear market looks on full stochastics, the True Strength Index, MACD, and PPO. Continue to have a constructive, it looks like the long-term trend remains intact look here. S&P 500 relative to the monthly cloud.com bust bear market here, financial crisis bear market here. This also aligns with the counter trend move within the context of an existing uptrend thesis, with all of this taking place above a green monthly cloud. Cloud was also violated in the devastating 1973-74 bear market. If we look at the monthly cloud for SPY, present day look looks quite a bit different than this, and it looks a lot like these constructive periods that occurred within the context of a secular bull market, and a lot like these constructive periods that occurred within the context of a secular bull market. It's quite a bit different relative to this look here in February of 2001 and July of 2008. The additional loss after this cross, case A, 37%, case B, 46%. The longer we maintain this look, the more meaningful it becomes. Chart helps us with very long-term trends. Exponential 8-month moving average in blue relative to the exponential 9-month in red. What we have on our screen here, this is a full-bore bullish look. Secular trend thesis remained intact in October 2022. And notice the market righted itself in October of 2023 with some white space between price and that upward sloping 200-week. This looks better than this relative to longer-term confidence. Clients and regular viewers know from a weekly momentum perspective, this is the look in 2002 that we wanted to avoid. Market takes another devastating leg down. This is the momentum look that we want to avoid in 2008. The market takes an extremely painful additional leg down. Present day really doesn't look anything like that. In fact, it looks a lot more like the period after the major low in 2016, after the major low in 2011, and after a correction in 2010. These are the failed rally looks on weekly RSI that we've covered numerous times. We look much, much better in the present day. This really doesn't look anything like this period in here. Chart here on January 12th, 2023, over a year ago, had work to do. Had work to do down here looking at the 30-week in isolation. Compare this look here to the what we want to see look here after the major low in 09 and after the major low that occurred in October of 2002. If we fast forward and look at the exact same chart, this one January of 2023, relative to what we're looking for, we can make an argument that this box here is represented with this look here after the October low in 2023, going on to print a new high after a scary retest. Caveating the next statement with that it's extremely important to respect how markets operate in the real world, which means even if really good things happen, at some point we're going to have a pullback, we're going to have a correction, and it's going to feel like all of this bullish evidence is irrelevant. That's how it always feels during pullbacks and corrections. It's something that we want to keep in mind when the market is still near an all-time high. Even within the context of a secular trend, volatility is 100% normal and to be expected. Charts that we have in front of us today tell us to keep an open mind about much better than expected long-term outcomes within the context of what could be very high volatility and significant drawdowns between a point A and a point B that hypothetically could be several years down the road. Chart on your screen is dated January 4th, 2024. Same chart on February 1st. Back in June of last year, we covered the trend meter on the bottom of your screen. This is a good look that we have on February 1st. And the chart that we covered in early January and the one that we just covered in early February align with the 75 years of stock market history that we covered on January 19th, telling us that from a probability perspective, this painful period back here is most likely behind us. And everything that we covered this week aligns with everything covered in this analysis that you can find on our website by Googling the title on your screen. On February 2nd at 10:53 a.m. Eastern Time, the S&P 500 was up 43 points for the week, and we still have that favorable look where the long-term trend appears to be intact with the 200-week here. And the intermediate-term trend seems to have had a counter-trend move within the context of that longer-term and still ongoing secular bull market. And remember, last week we covered numerous breadth-related studies that told us to keep an open mind about much better than expected long-term outcomes. It doesn't tell us much about the next 3 days, 3 weeks, or 3 months. And everything that we covered last week aligns with the thrust covered on your screen. Source of the data here, this is a Twitter handle. After similar historical thrusts 12 months later, S&P 500 was up 95% of the time, median gain 18%. And while everything still looks good, and we believe that there's still favorable long-term opportunity in this market, at some point, a drawdown is coming. And if we think about it and prepare for it emotionally in advance, we're going to be able to assess the data at that time in a much more prudent and rational manner, allowing us to better assess whether or not that drawdown is morphing into something that is starting to drift from the secular trend and favorable demographic thesis. We're not making any assumptions about what tomorrow is going to look like. We'll continue to manage against the base case. Because we all know getting stuck on any story, even a bullish story, can end up causing serious financial harm. Let's shift gears to the broad NASDAQ Composite Index. Present day look is similar to this favorable period, this favorable period, this favorable period, with RSI recapturing the 50 level and price recapturing the center line. This chart's dated February 1st at 11:40 p.m. Eastern Time, so that would be Thursday of this week. Not a significant breakdown on the daily momentum for the NASDAQ yet, with daily RSI holding above 50. Same can be said for the look relative to the 8-day moving average in blue all the way out to the 50-day here. Still have a full-bore bullish look with the 30, 40, and 50-week moving averages, and a favorable look with the True Strength Index, which speaks to monthly momentum. Very similar concepts here. We have PPO on the bottom, just a different look with the 200-week here. Secular bull markets tend to make a stand at or near an upward sloping 200-week. How about the narrower NASDAQ 100? If you pause your video player and study the monthly cloud, this is a favorable look here from a probability perspective. Chart dated February 1st, 2024. 30, 40, and 50-week NASDAQ 100 maintaining a confident and bullish look. Moving on to the Dow Jones Industrial Average. Market starts going sideways in Q1 of 2022, and we all know the longer a market goes sideways, the bigger the move that we can expect to get if we get a bullish breakout or bearish breakdown, and in this case, we still have what looks like a successful bullish breakout and a much improved and constructive weekly cloud, and arguably a better look with the 30, 40, and 50-week moving averages than we've had in quite some time. Weekly momentum getting a little bit of a scare last October, but with a much more confident look and well above the zero line here. Shifting gears to the S&P Composite 1500. February 1st, price above all of the moving averages, including the 50-week moving average in green. Contrast that with the look on November 1st, 2023. Removing price helps us focus on the trends. 50-day in blue, 200-day moving average in red. 50-day moving average exceeding the high from Q1 of 2022. What can we learn? By examining some influential stocks such as Amazon weekly cloud, much improved relative to look in Q1 2023, checking all the bullish boxes. So look at the weekly Amazon chart on November 17th, 2022, well over a year ago. Compare and contrast the look relative to the 200-day moving average on February 1st, 2024. You can make an argument that's your left shoulder, that's your head, that's your right shoulder, and we're above the neckline, and the 200-week moving average looks like it's trying to turn back up. Capital One speaks to interest rate risk. Calendar year 2022, significantly different relative to the look in early 2024 weekly cloud. Continuing with the weight of the evidence approach, broad Dow Jones Composite secular bull markets tend to make a stand at or near an upward sloping 200-week moving average shown in red. Credit markets, corporate bonds trying to get above this multi-month base. Probably fair to say the look in early 2024 looks more like 2010 relative to the concerning look in 2008. Dow Jones Consumer Services Index. Very similar concepts if you compare and contrast the look on the right side of your screen relative to the look in '08. Weekly economically sensitive travel and tourism index exceeding the high from Q1 2021. Speaks to the strength of the consumer. Positive look with the 200-week moving average turning up and price above the 200-week. Talked about the potential head and shoulders, inverse head and shoulders pattern on June 15th, 2023 in a June 2023 video. Potentially the left shoulder, the head, the right shoulder, the neckline, with the neckline being right around 3,100. If we fast forward to the present day, February 1st, 2024, we can see that price is significantly higher and has exceeded on a closing basis the high from Q4 of 2021. Interest rates have calmed down a bit, but most likely the longer-term trend has flipped, with the bias being up. Keep in mind, when the bias was down for a long period of time, numerous counter-trend rallies. We can expect the same even if interest rates move in this direction in the next decade. It's rare for the VIX to go up and tag this line here and then come back down to the green line. Even rarer for the VIX to go up and tag the top horizontal blue line and then fall back to the green line. In fact, looking back to 1990, only happened twice. Third time, present day. In this case, when you got back here, good things happen in the S&P 500 for a long period of time. When you hit the green line here in 2013, the market trended strongly into this peak in 2015 and is still holding on to that long-term uptrend. Similar move from point A to point B. Value line geometric index speaks to participation. This is a chart that we covered in March of 2023 down here. Still have a constructive look above the long-term base. Confidence would increase if we can move away from that base. Similar to this look here in 1993 and 1994. And this is what happened next. Gold has been like a coiled spring for quite some time. It still looks constructive in isolation. It's got a lot of work to do on a relative basis, meaning if we take gold and divide it by the S&P 500. To make an argument, this is the best look that we've seen with these moving averages in quite some time. What can we learn? If we shift over to the ETF world, BIL divided by XLK, this move here, dropping below a green cloud, only happened one other time on this chart after the major low, shifting back to risk on in 2009. It's another chart that can help us with weightings. It's telling us that U.S. stocks are trying to pull away from their foreign counterparts. Chart on your screen, diversified basket of bonds. It says a lot about Fed expectations, inflation expectations, interest rate expectations, and that says a lot about valuations. This is the best look on AGG weekly that we've seen in quite some time. February 1st, we have a nice W formation. We have yet to clearly break from that W formation. Leveraged loans read risky loans. Chart's been very, very helpful in terms of keeping an open mind relative to risk on. Difficult to say it looks bad in the present day near a new high. Here's an example, foreign stocks in isolation, checking all of the bullish boxes. Weekly cloud. Covered this chart, it's dated November 30th. In a recent video, this is ITB home builders relative to RSP, the equal weight S&P 500. Also noteworthy, have a similar and constructive look with the sister ETF, home building XHB relative to RSP. This is calendar year 2007. Probably fair to say this is a long-term base. Also speaks to interest rate expectations, inflation expectations, and Fed expectations. Covered this chart back in October when we were in risk-off mode. It told us to keep an open mind about the resumption of risk-on. Benefit of hindsight, the correction in Q4 looks like a retest of this bullish breakout, and now it looks like a successful retest and successful bullish breakout above this base. Total world stocks, aka global stocks, trying to make a stand. We covered this in November near an upward sloping 200 week. Told us to keep an open mind despite the weakness that we had in the rearview mirror in the stock market about better than expected outcomes. This is the same chart a few weeks later on December 13th, exceeding this high here from July of 2023. If we fast forward to the present day, a lot of good things happening. Secular bull markets tend to make a stand at or near an upward sloping 200-week moving average, at or near an upward sloping 200-week moving average. This is October of last year. This is the weekly 200-period average. This is the 200-day moving average. The slope is noteworthy. Also, another chart that we covered back in October that told us to keep an open mind about better than expected outcomes. Growth relative to the S&P 500, left shoulder, potential head, right shoulder. You'd have potentially some type of upward sloping neckline here. How does the same chart look today? Better, worse, or about the same? It's a daily version. The advancement on the monthly version says better. This is also an improving look with momentum, an improving look with momentum. Price relative to the all-important 50-month moving average, very, very similar to studying the 200-week. February 1st, XLF financial sector trying to clear this multi-month, if not multi-year base here. All of it happening above an upward sloping 200-week moving average shown in red. Pause your video player here. This constructive look, compare it to this period, this period, this period, and this period. And then contrast it with this concerning look in 2008. And I might add, early in 2008. Tweeted about this chart and the potential longer-term bullish implications back on May 7th of last year. That turned out to be quite helpful. The chart held the breakout, consolidated here, has since exceeded that consolidation pattern, and still has a constructive risk-on look. Chart dated February 1st. If you use that pause button, look backwards. This is a constructive look here, monthly cloud, XLK. We'd all like to see the rally broaden out. However, right now, tech continues to lead XLK relative to RSP. This is a very long-term period of consolidation and indecisiveness on this chart. This is 2020 here. This is 2022 here, 2023 here, and February 1st, 2024 here. So far, this looks like a bullish breakout in favor of tech stocks relative to the equal weight S&P 500. All trends, including relative leadership trends, as we know, are going to experience counter-trend rallies from time to time. Talked about this daily cloud here in Q4 of last year. It was helpful when that cloud flipped green. Still a constructive and risk-on look February 1st. Weekly XLP, defensive XLP, divided by SPY. Around the office, we like to refer to long-term momentum as barge momentum. Much like a barge that's very difficult to turn around and not particularly agile, longer-term momentum tends to move in a barge-like manner. Thus, when momentum is going in the bullish direction, that's a good sign, and that's exactly what this chart says. Compare and contrast the present data 1982, 1984, 1988, 1991, 2003, and after the major low in 2009. We can move quickly here. The exact same concepts, constructive and bullish concepts, apply to the chart of the Dow Jones Industrial Average. All of this down here is monthly Copic. Ditto and constructive for the NASDAQ 100 monthly Copic, date February 1st on the chart. Ditto NYSE composite. So thus, in terms of long-term momentum, difficult to say that breadth is a total disaster. There's no question this is a narrow advance still, but things might not be as bad as most think. Not convinced yet? Same exact concepts applied to the S&P 500, similar to 74, 78, 82, 88, 03, and after the major low in 2009. Very constructive look here, making a stand at an upward sloping 50-month moving average, similar to this point here, and this point here in calendar year 1995. How about a closer examination of market breadth? Is it a total disaster? Constructive breakout here. Still has work to do here, but we have to admit this looks quite a bit better than what we had in August, September, and October of last year. And this looks significantly different than anything that we saw walking forward from Q1 of 2022 here. And it looks significantly better than this lame look here on November 9th, Q4 of 2023. We covered this chart in a November video. What once acted as resistance, may now act as support. This is tied to the NASDAQ, an index leader. This is tied to all major U.S. indices. It also has an improving, and this looks different, look, chart dated February 1st, 2024. When things are going well, it's always prudent to respect that givebacks and corrections, even double-digit drawdowns, are not particularly abnormal within the context of a bull market. Having said that, relative to the question on your screen, we don't have significant or really any evidence in hand to tell us that the look of the charts and stock market related data are starting to diverge from what is still strong economic data. As always, the comments in this week's video are based on the charts and data sets in front of us, and thus, we all know the only way that we can handle things properly walking forward is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.